From London and New York for our audience worldwide, Bloomberg Real Yield starts right now. We begin with the big issue, playing fiscal headline roulette.
This is all about fiscal policy.
Big fiscal policy push.
Everyone's been expecting any day now.
Fiscal stimulus.
More fiscal stimulus.
Large fiscal stimulus.
If we want the market to stay at these levels and behave,
it is desperately needed.
There's a view out there in the market that whatever happens, we will get massive additional fiscal support.
Will there be fiscal stimulus at some point? Yes.
Markets are expecting it.
It's pricing in, I think, that we'll get more fiscal accommodation.
Fiscal is not a given.
It seems like every day we don't know whether there's going to be a stimulus bill or not.
There is no urgency of any kind and no momentum to build off of.
I don't think it matters if we get additional fiscal stimulus.
Joining us now is Morgan Stanley's Matt Hornbach. Matt, great to catch up with you, sir. It feels like for the last 2-3 months, we've just been turning the volume up and down on the same song for the past 3 months and gone nowhere. Are we actually starting to change the track a little bit now, Matt? Are we actually making progress around these fiscal talks? And let me ask you one question, and I think the only question that matters right now. Does Senate Majority Leader Mitch McConnell have the votes to pass a $1.8 trillion package?
Hey, John, thanks for having me on. Look, I don't think the Senate Majority Leader needs all 53 senators to vote for this package. Ultimately, I think the choice here is between getting something done ahead of the election or waiting until after the election, seeing the outcome, and then making a decision about the stimulus package. And I think for markets, perhaps most importantly, the question is not necessarily whether it gets done ahead of the election, but just whether it gets done at all over the coming months. And I think we saw elements of that show up in the FOMC minutes from earlier this week, John, when the Fed made it clear that if there wasn't going to be stimulus in the next several months, that would be a problem. But look, as long as it gets done in some kind of a timely manner, I think the Fed will be pleased with that, as will the markets.
Matt, it's amazing to me how quickly this narrative has changed. A couple of weeks ago, it was all about a contested election and no fiscal stimulus. A couple of weeks later, we're now talking about the potential for a blue wave, getting a fiscal package at some point, regardless who wins. Matt, why the shift? What underpins that shift?
Well, John, I think a couple of weeks back, right around the time of the September FOMC meeting, there were several stars that aligned around that time. Of course, you had peak expectations for Fed dovishness. You had peak uncertainty around the outcome of the election and whether or not it would be contested. And then you also had peak doubt, I think, around fiscal policy at that time. Over the next couple of weeks, as we've seen, some of those uncertainties have moderated somewhat, and I expect that they will continue to moderate through the end of the year. So I think that sets up markets for a really interesting trade around this election. Once this uncertainty passes us, we're going to see animal spirits, I think, revive. And John, let me just say that there's plenty of cash to put to work. There's over $5 trillion in money market funds, John, and it's not earning very much. That money is not going to stay in those money market funds very long, especially when the uncertainty is reduced. So,
assuming that cash and a cash position, Matt, isn't the new risk mitigation strategy, maybe people just aren't comfortable being in treasuries anymore and they're just chucking their money into money market funds. Maybe that's where it stays.
I think at some point that money will find its way into a variety of fixed income asset classes. And then eventually it may seep into other types of riskier asset classes. But John, ultimately, treasuries at these valuations are not attractive really for any type of cash, we think. And so we've been quite negative on the treasury market for the past several weeks. We think there's a couple of things that you can do against this. Of course, one of them is to put some money into the German bond market, where we think the supply dynamics favor German bonds over U.S. treasuries. So we are recommending that trade, John.
So you're long bonds, short treasuries, Matt. It's a trade that's become quite popular. Can you just walk us through it?
Well, yeah. In terms of the supply dynamics, I think it's pretty clear we're discussing another very big round of fiscal stimulus in the U.S. Almost certainly that is going to allow the U.S. Treasury to increase its coupon issuance. In fact, even if we don't get a stimulus package ahead of the election, we are expecting the U.S. Treasury to increase coupon sizes in November. So you have a supply tailwind to higher yields in the U.S. And opposite to that, you've got reduced supply, not only in Germany, but in other parts of the euro area, like Italy, for example, where we remain quite bullish on BTPs. So the trade that we're recommending not only is to be long BTPs versus boons, but to be long boons versus treasuries and gilts, where we think the supply dynamics there favor higher yields in the UK as well as in the US, John.
So, Matt, let's deal with the Bund Treasury spread right now. Bund yields negative 50 basis points, 10-year maturity, sitting right on top of the policy rate, anchored. Get all of that, fine, done, dusted. Treasury yield has started to move back out. The range 50 to 90 basis points over the last 5 months, in and around 75 to 80 over the last week. Now, Matt, for me, what is interesting about the long end of the yield curve is when Loretta Mester over at the Cleveland Fed starts to make some friends. Makes some friends and gets a crew together on the FOMC to push back and say, we need to get QE and the buying further down the curve to put a lid on this. Have you got an idea of the kind of yield level that would test the tolerance of Mester and co?
Yeah, John, I think we've got some wood to chop before we really get serious about the FOMC pushing back on higher yield levels. Bear in mind, John, that the Fed thinks that the neutral policy rate is at 2.5%, and right now the 30-year long bond is about 100 basis points below that longer run neutral rate. So from the Fed's perspective, Treasury yields are extremely low and very supportive of easier financial conditions. So I would venture to say that if the 30-year long bond got above 2%, John, you know, you'd start to see some eyebrows get raised at the Fed. I think for the 10-year Treasury yield, which is almost 200 basis points below the Fed's longer run dot, you'd have to get, I think, well north of 1% before you started to hear alarm bells going off at the Fed, John.
Hey, Matt, really interesting stuff and always great to catch up, sir. Matt Hornbach there of Morgan Stanley on some of the calls coming out of him and the team over the last couple of weeks. Time for the final spread the week ahead. Coming up over the next week into the weekend and out the other side, bond markets closing Monday in the US for Columbus Day. Plus ECB's Christine Lagarde is speaking. On Tuesday, we get US CPI and the IMF publishing its World Economic Outlook. US PPI and Fed Vice Chairman Richard Cloud are speaking on Wednesday. Initial jobless claims coming on Thursday and closing out the week on Friday with a big data point, US retail sales. From London and New York, that does it for us. We'll see you next Friday at 1 p.m. New York time, 6 p.m. in London. This was Bloomberg Real Yield. This is Bloomberg TV.